Hello everyone and welcome back to the podcast. This is an update of my original Spotify thesis. My investment is up nearly 5x at present, and although this may be surprising to many, to me it's not, because Spotify is a perfect instance of the sort of company that I teach my students to spot in my Tech Stock Goldmine course. So basically I was able to spot Spotify, no pun intended, as a future up-and-coming free cash flow machine early because I understood the Costco algorithm better than others, and I was able to spot it in this company in particular. So let's dig into the quarterly update now. For decades, Spotify has been focused on growing its subscriber base and increasing engagement by relentlessly increasing the value delivered to customers. In turn, Spotify only increases prices sparely when the gap between value delivered to the customers and price is wide enough for price increases to have no negative impact on customer lifetime value. You may notice that this way of operating is an instance of the Costco algorithm minus the obsessive cost reductions. Now that Spotify has embedded cost efficiency into its algorithm, the sky is the limit in terms of financial performance from here. With this organizational update, Spotify is now on its way to becoming one of the strongest businesses on earth. As you can see in the graph below, quarterly free cash flow yield is now growing exponentially, coming in at a record 12% in Q3. However, this enhanced ability to produce cash is merely the result of a few price increases, decreased investments in the podcast space, and increased cost efficiency across the board. Indeed, Spotify now has decades ahead of solving a growing volume of acute customer pains, both for creators and consumers, while growing its subscriber base. This endeavor will greatly magnify Spotify's cash flows going forward. I can't predict the future, but I can spot vehicles that are more likely than not to successfully overcome obstacles along the way and ultimately profitably solve problems for customers in a way that's increasingly harder to imitate. And that's just what I've done with Spotify. As such, I couldn't possibly predict that gross margin was going to come in at a record 31.1% this quarter. But I did understand that once Spotify incorporated cost efficiency into its operational algorithm, financial performance was a natural byproduct down the line. I use the term algorithm as a more tangible equivalent of the term culture, which I quite like, since the former implies routinely taking a number of steps. Spotify is now effectively a machine that delivers more value, monetizes more, and reduces costs more every day. Over a long period, these daily actions taken as defined by that algorithm will likely compound into a business 1 or 2 orders of magnitude bigger than today. With my investment up nearly 5-fold at present, I believe this will evolve into a historic investment. At this stage, Spotify is still in the process of deploying its new verticals, including audiobooks. In the Q&A section of the earnings call, it was interesting to learn that subscribers that engage with audiobooks consume content on Spotify for 5 more hours on average. This is further evidence for Spotify's ability to identify new verticals that can increase ARPU, average revenue per user, and capitalize successfully on the opportunity. While Spotify has only publicly talked about the music, podcast, and audiobook verticals, Ek mentioned in the call that Spotify doesn't plan on stopping just there.
So as you think about Spotify in 2025 and beyond, picture a company that operates with the same disciplined management you've seen this year, but one that also has the ambition to seize the opportunities presented by what's happening in technology. In the near term, I see potential for transformative shifts in music discovery and new innovative ways to connect artists and fans like never before. All great stuff for the music industry, which will drive further growth across our core business. And just as we successfully entered the audiobook space, we're committed to making the targeted investment that also expands Spotify into new areas, enhance the platform, and deepen the value we bring to users.
A lot of the spectacular growth in the mouse side of the equation, meaning monthly active users, in the past few years has come from Spotify giving customers more options. The range of subscription plans is now broader than ever, and Spotify has plans to introduce a super premium subscription tier. Allegedly, this tier will give subscribers access to increased proximity to their favorite artists and improved sound quality, among other features. However, it would be futile to spend time trying to figure out the exact properties of this tier and modeling just how much it can enable Spotify to increase ARPU and how it would equate to the bottom line and the free cash flow yield. My view is that so long as the Spotify algorithm continues to get better over time, all sorts of new things will emerge that will simply deliver more value to customers and thus increase LTV, lifetime value, across across the board, and this will ultimately enable Spotify to become a bigger business. This mental abstraction you will find is particularly applicable to most of the valuation models that people have done on Spotify in the past few years, certainly the ones that I have seen. People try to value this business by using an Excel model, and I think that they absolutely miss the point. And continuing to value Spotify as such means missing the point going into the future as well. When it comes to understanding a company of this sort, it is paramount to get a grasp on the concept algorithm. And this is also true of a company like Costco, which you can go and check out the deep dive that I published a month or two ago. And you will see how the algorithm for Costco has translated into incredible returns for shareholders for decades in a way that no model could have possibly foreseen. I think that to get early into Costco and capture all of those returns, you would need to be operating in a similar way to Charlie Munger. Actually, I start the Costco deep dive by quoting Charlie Munger in his last podcast ever, just before he passed away, unfortunately, when he was asked how did he know he was going to succeed with Costco, and he simply replied that the parking spots were wider. Now, to the untrained eye, that doesn't really mean anything, but to me immediately it meant that Charlie had a qualitative insight into the company's algorithm that obsessed over customer satisfaction more than other companies, other competing companies, and that's why they had wider parking spots. I thought that was absolutely genius, and I connected with Charlie Munger with that short phrase like I haven't connected with any other investor ever, probably. Now, going back to Spotify saw a bit of a slowdown last quarter in terms of MAUs, again monthly active users, in terms of their growth. The year-over-year growth has slowed down further this quarter, coming in at 11.4% in Q3 versus 13.6% in Q2 and 19.4% in Q1. Although there is tangible evidence that Spotify can now grow and be profitable at the same time, we are yet to see MAU growth reaccelerate to prior levels. This is not something that concerns me, since historically the company has alternated between focusing on growth and focusing on financial performance and other metrics that are not directly related to growth. However, in the Q3 earnings call, Ek said that they are back to growing MAUs again, having missed the guidance in Q2, and that the reacceleration is due to product iterations. You guessed it.
I think it's early days, but I do believe we turn a corner and are back to a growth again on the MAU side, and I'm happy about that because I wasn't happy about us missing the prior forecast. So it feels like we've got a good grip of it now. Now, as it relates to what do we do to make that happen, the reality is it's a bunch of different things, but the chief among them is really product improvements. So lots of small tweaks that have been driving good results. The things in the past that probably weren't smart, we've reversed. We've added new things as well. All that's created, the backdrop of stronger engagement, which then translates to more MAU.
According to Ek, AI DJ has turned out to be one of the few features that moves metrics across the board for Spotify. In the Q&A section, he explained how most progress on the platform is due to many iterations, many features that amount over time to yield tangible improvements. He also explained how rarely does one feature quote-unquote move things in the aggregate. This feature, AI DJ, is testament of the Spotify algorithm and how trying to model or predict their progress over the years is a nonsensical exercise. Ek said the following about the AI DJ during the Q3 call.
AI DJ, we're seeing amazing results, not just on quantitative metrics, but also on qualitative metrics, how people feel about Spotify, what they say they love about Spotify. Both music videos and AI DJ are showing up in pretty great ways. And I think this showcases the strength of Spotify. We are at our best when we can bring great innovation to our consumers.
Many of you have correctly pointed out in the past that YouTube and Spotify are set to collide in the future, with both currently starting to compete for eye share in the video podcast business. A widely underappreciated fact about Spotify is that the company has been going against much larger competitors repeatedly since inception. It's borderline miraculous that they've managed to offset both Amazon and Apple in the music business, with the former leveraging its operating system level advantage to compete and still failing to do so. In the call, Ek explained how they've managed to do this repeatedly and how he believes they will succeed again going head-to-head with YouTube.
Well, if you look at the history of the company, we've always been up against much bigger companies and platforms. And I feel like this is the story of Spotify. And we don't really, as we're entering spaces, we don't think too much about competition is the honest answer. What we do think about is what are the needs of the consumer? What are the needs of creators? I hope you'll follow along in what I'm sure people will live tweet and all that from the event, where you can see really our philosophy at play, where we're solving real creator needs, where we're solving real consumer needs that we're seeing. And it's really how we're pursuing this. I think that there's not so much, people make it out to be this sort of the winner takes all dynamic, in that there's only one player that can solve all of it.
Spotify ended Q3 with 6.1 billion euros in cash and just 1.3 billion euros in debt. And with the rising cash flow production, Spotify's financial health is set to meaningfully improve from here. And already the balance sheet looks very healthy to me. Over the next year or two, I believe the market is set to discover that Spotify is a world-class business. Looking out further into the future, the potential for Spotify to continue increasing its free cash flow per share levels has no real limit. And so long as the Spotify algorithm continues to improve over time, I believe that shareholders will continue to be handsomely rewarded. Alright, that's it for today. Thank you very much for joining me. If you enjoyed it, as always, can you please share this with one friend whom you think will enjoy it? These deep dives are for free, and so the only way this grows is with your help. Thank you very much, take care, and until next time.